Listen, I want to give some clear messaging on rates because mortgage rates today are it's wild fluctuation and wild, like this crazy Trump tariff trade terrorism. It's pretty good, right? But anyway, this stuff is just really causing all kinds of mortgage rate uncertainty. I know that sometimes that's hard for the public to follow, but it's just true. Let's face it, there's two kinds of mortgages. There's variable, that's all driven by the Bank of Canada. The Bank of Canada is the one who sets the rate for variable. It can increase, it can go down. More on that later. But fixed rates are a function of bond yields. Bond yields are the sale of Canadian government bonds. That's a 5-year, a 4-year, a 3-year, a 10-year. That's what mortgage rates are based on. A 5-year mortgage rate is based on the 5-year bond yield from the sales or lack of sales or buying of Canada government bonds. That's how we finance our debt in Canada. That's how we finance it's the baseline of our whole country's debt. So these last 10 days have been, to coin a phrase, batshit crazy. Like they have absolutely been off the wall. We've had a plunge in particular. Let's use 5-year. It's an easy example. 5-year bond yields. People like 5-year fixed. It's great protection. It's long-term protection. So, why don't we get 30-year mortgages, Ron? We just don't have them in Canada. So until we do, we should stop talking about them. So the 5-year fixed, the bond yield, when the markets sold off, when Trump held up the cardboard chart and said, yeah, we're going to tariff the hell out of all these places. When that happened, the stock market fell like a rock. It was a stock market crash, temporarily, we found out. And when money flows out of equities, flows out of the stock market, it's got to go somewhere. Computers sell the equities and they buy bonds. So immediately bond yields fell. Bond yields hit, I think that the lowest low was 2.42 5-year fixed. Then more gyrations, more crazy town, more, first of all, people, the U.S. Treasury is their version of a bond. They call them treasuries in the U.S. And U.S. Treasury yield just went wild at a certain point. It came down a little bit, and then it just went nuts high. Then suddenly our bond yields started to follow because at the end of the day, United States sneezes and we catch a cold. So that's what happened there. These bond yields went from 242 to 286. It was crazy. 40 basis point jump. Like I can tell you, you go back 10, 12, 15 years, or even 8 years, there were some 6-month periods where bond yields wouldn't even change that much. They were that steady. We're talking about a matter of days, bond yields going crazy. So now all of the sentiment shifted to higher mortgage rates because when bond yields were floating around 2.62, dropped all the way down to 2.42, went nuts to 2.86 at the top, very top, intraday. So they're sitting today, as I speak, they're sitting around 280. Might have come down a bit. That's when we were hitting for the 2.4 was also when we were starting to grab a lot of low rates. Now, they'd gone down before this super low point of the market crash, but still, that created some low rates. We got some 369, 364, CMHC 5-year fixed, got 379, 389, 399. Conventional, that's just every day of the week. Banks are offering that as a conventional refinance, all below 4. I've talked about it a lot in social media. Now we're looking at pushback on that. We're looking at those rates just might have to edge up right back to 4 and maybe even a touch over 4. We'll still probably have some 399, 389, 384. And who knows? It could change all over again in a week. Who knows what the hell's going to happen? You never know now. It's just a mystery. So what should we draw from that? Here's what you need to understand. If there's going to be a bad recession in Canada, there's going to be a bad recession. Stock market moving up and down. All of the traps are laid out for a recession in Canada. It's all there. I mean, nobody can save it. Even massive government spending can't fix it, really. There's so many things pointing in that direction. In the face of a big recession, the smart money would say, the Bank of Canada, now I'm talking variable rate. So variable rate, which today you can get for about 4%, 4.2, 3.8, somewhere in there, 4%, that could come down very easily another 50 basis points. Bank of Canada could drop 50 basis points, maybe 25 and 25. The meeting is just in a few days, okay, the next meeting of the Bank of Canada. So that could happen. But in a really, really ripper recession where unemployment's just spiking like crazy right across Canada, it's it's in the sixes today. Let's say it goes to the eights, the nines, okay? You could see a much bigger cut. You could see a cut down to, you could see 125 basis point cut by Tiff Macklin at the Bank of Canada. And that would take variable mortgages all the way down to like 2.95, 3.15, right down there, that low. But how long would they stay? Because the danger of inflation rises so much when tariff wars are going on, when, what we're looking at right now is energy is at an incredible low, gas, oil, incredible low, and that can easily come back up, just not enough oil coming out of the ground. So that's what we have to consider, that the inflation could come back. Food prices already seem to be rising. And if inflation comes back in a very serious way, the Bank of Canada has to raise rates. So here's the biggest key to understand it. By the way, the poor guys in the U.S., we said it went up 40 basis points. It went up 80 basis points. 80 basis points for U.S. Treasuries, okay? Their 30-year mortgage went to 719. 719? Holy gee, oh, that's nuts, okay? Canada, we just go home. Or close or something. But yeah, it's tough in the States right now for a mortgage, really tough. So here's my point to you. When that inflation hits, whether it's the end of this year, whether it's the beginning of next year, by the time everybody just wakes up and the Bank of Canada starts raising its rates, there's an excellent chance that bond yields will have forced fixed rates right up from 4 to 5, 5.25. That's what happened last time. If people remember 3.5 years ago, that's what happened. By the time the inflation was really locked into the Bank of Canada and it was going through the roof, it had already gone up. Fixed rates had gone up already. So this is my message to you. If you have variable today, if you're considering a purchase today, if you want to refinance your mortgage today because you're at 5.29 and you want to get back down into these 4% rates, don't be greedy. Don't wait it out. Don't think, oh, I'm going to wait till it comes way down again. I'm going to wait till it goes down to 2.2, 3.3. I'm going to wait till it's really good. It may never happen in the next 2-3 years. 3.79 may be the best you're going to get. So please, my message to everybody is, I supported variable rates for 16 months and I was right. But now we have to start to think about when to lock in. If you can get 3.79, take 3.79.